Our next speaker is Ellen Brown, who, of course, needs no introduction, but nonetheless, I will give a brief rundown. Ellen was a lead founder of the Public Banking Institute and author of the groundbreaking books Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free, and the 2013 book, The Public Bank Solution, From Austerity to Prosperity. She is presented on public banking in North America, Europe, and Asia. She conducts the radio show It's Our Money and the TV show The Public Bank Solution. She currently chairs the Public Banking Institute. Her blog, Web of Debt, has hundreds of articles shining a bright light on the many advantages of public banks for a better world. Let's welcome Ellen Brown.
Thanks, Sarah. I just have to say, Walt McCree's here. He actually does the radio show and the TV show. I just appear. Okay. All right. So I hope I've done this PowerPoint before here, but I varied it. I hope it's going to be different enough not to bore you. But I understand there's some people that aren't familiar with public banking, and so I'm taking it from the top. Globally, 25% of banks are publicly owned. In the 1990s, it was 40% were publicly owned, and then we had a wave of privatizations. It was thought that private banks were more profitable, but in 2008, it became evident when the private banks crashed. The public banks were the ones that did particularly well, and the countries that had strong public banking sectors were the ones that came through the crisis particularly well. So there's been a renewed wave of interest in public banking globally. Some of the largest banks globally are publicly owned. The largest banks by market capitalization are in China. Largest bank by deposits is Japan Post Bank. It's actually partially privatized, but it's still predominantly publicly owned. The largest bank by number of branches is in India. Largest development bank is in China. And then the world's 7 safest banks are also publicly owned, leading with KfW, which is the German public development bank. Recent studies have shown that public banks are actually not only safer and less corrupt, but they're actually more profitable than private banks. And that's also true of our one and only state-owned bank, which is the Bank of North Dakota. They lend counter-cyclically, so when the other banks are pulling in their loans, like they're afraid to lend, then the public banks are out there lending even more. And you could particularly see that in China in 2008 after the collapse. Their public banks were out there making all kinds of infrastructure loans, all kinds of loans, and that's what kept their economy going. The Sparkassen model in Germany is particularly interesting. Half the commercial banks in Germany are publicly owned. These two are more profitable. There was a 2015 study that showed that the public banks, the Sparkassen banks, were actually more profitable than the private banks, and they've been responsible for increasing the switch over to solar energy in Germany. I guess I can't read my own thing at this distance. Anyway, 41% of their electricity is now solar, which is, leading the world for solar. And the Sparkassen banks finance that. They also have been credited with pulling Germany out of, bringing it up from where it was after World War II, when it was actually, the economy was totally collapsed. And now it's the leading economy in Germany. And this was largely due to their publicly owned banks that they lend particularly to the small and medium-sized businesses. There are over 250,000, 15,600 branches. So these are all independent banks in their local communities. They're not, it's not like one big, like Chase Bank or something. They're independent. They're not allowed to expand beyond their local communities, and they predominantly lend to their small and medium-sized businesses. China is another, probably the leading example of what you can do with publicly owned banks. 80% of their banks are publicly owned or state-owned, and they are like leading the world in infrastructure. Their high-speed rail is the prime example. They built 12,000 miles of high-speed rail in the decade while we were just arguing about how to fund it. And how did they do it? They own their own banks, and as Michael pointed out, banks don't just re-lend their deposits. They actually create money when they make loans. So that's what the Chinese banks do. They just lend it into existence through their state-owned banks. And then if it's something like railroads, the proceeds from the railroads pay back the loans. So you put the money out there first. That's the whole model. Instead of saying, well, we've got to get the money from somewhere else, you create the money as a loan, and then it comes back to you in the form of proceeds. So we have one in the United States, that's the Bank of North Dakota. It's 100 years old, going back to when the North Dakota farmers were losing their farms to the Wall Street banks, and they decided they wanted to keep their money local in North Dakota. So there was a populist movement. It was called the Nonpartisan League. They managed to win an election. They had a quite inspiring, charismatic leader who won an election, and they set up their own state-owned bank. And so the model is, and has been for 100 years, that all of the state's deposits are deposited in the bank, and then this money is, well, deposits aren't leveraged. So, anyway, so they have a big capital base, a deposit base, and this creates credit for the local economy. In 2014, the Wall Street Journal published an article saying that the Bank of North Dakota was actually more profitable than Goldman Sachs and JP Morgan Chase. In fact, it had a 70% higher return on equity than those two major leading banks. That article attributed it to oil, but in fact, the oil boom, or North Dakota has had record profits for the last 15 years, and the oil boom didn't really hit until 2010. And right after that article was written, or in 2014, oil started collapsing, and it massively collapsed after that. So North Dakota itself, like other oil states, really, suffered from this. But the Bank of North Dakota continued to report record profits year after year. So now they have assets of $7.3 billion. That's assets are basically their loans, and a return on equity of 15.5%, quite good. So their business model is, if it's not oil, why are they so productive? It's their business model, which is that they don't pay bonuses, fees, or commissions. They don't have shareholders that are bleeding the profits out. They don't have to do like short-term returns for the shareholders. They can think long-term for the community. They don't have high-paid CEOs. They don't advertise. They have a built-in or a captive deposit base, which is the state itself. So they don't have to advertise for deposits. They don't have to advertise for loans. They don't compete with the local banks. They actually partner with them. So the local bank finds the customer, finds the loan, and then if it's a loan that's too big for the local bank to take, then the Bank of North Dakota will step in and help with capitalization and liquidity. And they do quite a few other things for the community as well, like when they have disasters, et cetera. I mean, they're there to serve the community, and they do serve the community. They don't need a lot of branches. They don't need ATMs. They don't need tellers, et cetera. I mean, a few, but that's not their... I think they have like 3% individual depositors, and that's only because they thought, well, we're a public bank. I suppose we should take deposits. But they don't make it easy. You have to almost live right in the, right near the bank in order to bank there. So they spread this profitability in the community. They share their profits with the community. They make 2% loans to local communities for infrastructure. This would be school, et cetera. In fact, I saw one in 2014, the same year when supposedly oil was collapsing. I think it was when, or maybe it was 15. Anyway, it was when oil was way down. They were making 1% loans for school districts to build schools. And in California, we're paying, the school districts have really no recourse but to fall for these capital appreciation bonds. I saw one where they'll be paying 1,500% by the time they pay the thing off. I mean, 15 times what the original loan was. In other words, the way these are Wall Street, it's Goldman Sachs, I think, principally that sells these, and they come in and talk to the school boards and they say, oh, don't worry, it's basically subprime for school districts. They say, don't worry, you won't have to pay a thing for 30 or 40 years. But then you get hit with this giant balloon payment because the interest compounds while you're not paying anything. So that's what they're doing to their grandchildren, whether they know it or not, I don't know, but yeah, it's horrible. They make low-interest loans for affordable housing, 1% loans for startup businesses, and they have this unique policy where if for every $100,000 of loans to a business, they have to create a new job. So they just do many things to help the community. And the local bankers love them. The Bankers Association endorses the Bank of North Dakota. They have 6 times more community bank or local banks per capita than any other state, and this is largely because the Bank of North Dakota supports the community banks rather than in other states like California, where the big banks are basically gobbling up the little banks. They can't compete, and it's they're being overregulated, et cetera. So in other states, by comparison, New Jersey, for example, is paying 10% of their budget just for finance charges. That's for interest. The New York Times had an article in 2015 saying that their public pension funds were essentially all the money was going to Wall Street for fees. It was $2.5 billion, and it wasn't obvious. It was kind of buried in their literature, but it was all going for fees. In California, in 2014, there was a study that found that the city was paying more to Wall Street in fees than they were paying for the roads, to fix the roads, which are in pretty bad shape. So that's where we are, where state and local governments are quite broke. And they need a new source of funding, and you're either robbing Peter to pay Paul, or you need some new source of money, and that's what you can get out of a public bank, because banks actually create our money supplies. So if you get more loans out there, then you get more money into the community. In the San Francisco Chronicle in 2016, there was an article saying that 1 of every $2 spent on infrastructure goes to interest. So that's 50%. It's like when you buy a house and you pay for 30 years, and by the time you're done, you've paid as much or more in interest as you paid in principal. Well, infrastructure's like that. So I have 2 examples there. The Bay Bridge retrofit in San Francisco. The part that the voters approved is $6 billion, but by the time they're done paying it, it'll be $12 billion. And likewise on the bullet train, the part they approved was $10 billion, and by the time they're done, it's going to be close to $20 billion. So in theory, you could see that you could, if you own the bank, you the state own the bank, then you could cut your infrastructure costs in half, because you would be getting all that interest back. I mean, even if you didn't give yourself any, you don't have to reduce the interest rate or anything, just you own the bank, you get the interest back. So it looks like a good model, but what you'll hear from legislators first, they'll say, well, we don't have the money to lend. We can't lend our deposits. We need that money to pay our budget. But this misunderstands how the nature of banking and finance. As Michael read this very same quote that's from the Bank of England in 2014 from their quarterly report. Money reformers have been saying this for 100 years, but we now have the Bank of England saying it, the Bundesbank saying it, the Federal Reserve has said it at different times, sort of buried in their literature, that banks do not lend their deposits. They actually create the money they lend on their books. So, for example, if you take out say you take out a $500,000 mortgage, the bank will write $500,000 on one side of their books as an asset to themselves, because you're going to pay that over time with interest. And then they'll write another $500,000 on the other side of their books as a liability to themselves, because when your check goes out of the bank into another bank to your seller, that the first bank has to cover it. So let's say you have two banks doing the same thing. So they're both creating a $500,000 loan, which becomes a check, which finds its way into the other bank. So you've got both banks have $500,000 coming in, $500,000 going out, their books balance, but you've just created $1 million that did not exist before, $1 million that's out there circulating in the economy. So banks have these checks coming in and out all day. Their banks all across the country are creating loans. And so hopefully you get the same amount in as out. You know, that's what bankers do, is figure out how to balance keep that balance level. But if it doesn't work, if they're short, they can borrow. They can borrow overnight on the Fed funds market, which means borrowing from other banks. And some other bank will have excess reserves because you just created some excess that went into some other bank. So they're all basically one big system, and the money goes out, and then they borrow it back to balance their books. They just borrow it overnight, and they give it back the next day. They might borrow it over and over and over until their books balance. But anyway, that's what bankers do, and that's exactly what your public bank would do. The same thing that every other bank does. They would borrow from other banks or from the Federal Home Loan Banks, which is an even better deal, or from the repo market or the money market, etc. So they're very, what they typically do, a conservatively run bank will lend perhaps 70%, lend a sum equal to 70% of their deposits. So let's say you're the state, and so you would still have 30% of your deposits there that are completely liquid, that you can tap up at any time. But even if you went below that 30%, you can do like other banks do, which is borrow in the Fed funds market, borrow from the Federal Home Loan Banks, borrow in the money markets. So another objection we hear from legislators is, well, we already have loan funds that are, doing these loans that you're talking about. We're already lending to build or whatever, all these different things they do, housing. Why do we need a bank? And the answer is you can make a lot more money if you run it through a bank. It's leverage. So let's say the California Infrastructure Bank is a prime example that there's a movement on right now to turn it into a depository bank. So it already has $400 million, which isn't all that much. It's, it could do a lot more business than it's doing. It's got $400 million that's sitting there in a loan fund. It's already been designated. They don't have to borrow it from anywhere. They've got the money. They've got $400 million. So right now, what they would do is lend the 400 out, maybe at 4%, and wait for it to come back and lend it again. So if you lend it at 4%, I think I used 500 million in that example, but you lend it at 4%, you're going to get a $20 million return. Now, if you use that very same 500 million, you call that capital for your bank, you can then lend 10 times that sum, because you only need you only have a 10% capital requirement. So instead of making 500 million in loans, you can make 5 billion in loans. So that's somewhere around what the Bank of North Dakota is doing, for example. And their operating costs are 30 million annually, or this last year, that's what they reported, 30 million. And then you're going to have some cost of funds, so that you're going to need 5 billion in deposits to, in theory, you're going to want a big deposit pool. So in California, the Treasurer's investment pool is paying 1.4%, or earning 1.4% on, I think it's up to something like $76 billion now that's sitting there. I mean, it's basically where all their excess money goes. It's all their excess funds, but it's not earning very much. And that's also what you would pay now on that's the Fed funds rate is 1.4%, which is actually quite high. It used to be 0.25%. But even if you pay 1.4% and you're making 4%, then you've got your cost of funds. So that's $100 million for your cost of operating costs. So you've got $100 million for your cost of funds and $30 million for your operating costs. Maybe I didn't do that right. You got $70 million for your cost of funds and $30 million for your operating costs. So that's $100 million. You're still making $100 million, which is 5 times what you would have made with a revolving fund. And your funds are just as safe. We would argue they're more safe than if you put them in Wall Street. So I think this is that slide's on liquidity and risk, but I think I already went through that. So, for example, if the state, I've heard this from our state treasurer, said, well, there's a period like right before tax season when our budget or our funds go way down. Well, during that period, you can take out a three-month loan for 2% at the Federal Home Loan Banks. So you're just borrowing cheaply. You're borrowing at bankers' rates instead of at municipal rates. So instead of paying 4% or 5% or whatever you pay on your infrastructure, you're now paying 1 or 2%. So where can you get these deposits? You would get them from your in Colorado, as I read your CAFR, your Comprehensive Annual Financial Report. You've got $2.5 billion just sitting in cash, and then $6.8 billion in the Treasurer's investment pool that's earning 1.5%. So you've got that money. You've got pension fund money. I mean, all these things have various sorts of restrictions on them, but you've got pools of money that could be used that are sitting somewhere now, and you can pay them exactly what they're making right now, and basically leveraging for your own closed-loop community purposes, as Michael says. But there is another potential source of funds that I know everybody's interested in here in California, and that is the cannabis money. What are you going to do with this money? We have the same problem in California where it's a $7 billion, they're anticipating a $7 billion business, $1 billion in tax money annually. So our treasurer is really seriously looking at, they really want a public bank, and they're willing to bend a few laws here to get it set up. So that is one possibility. If you took the cannabis money, not only do you not have to pay 1.4%, you can get that money for free because these people are desperate for a place to put their cash. So you just put it in an account, and so you'll be making 10 times what you would have made on a loan fund. So it would be a very good deal. Of course, there are a few downsides. For one thing, if you're following the Bank of North Dakota model, you don't want to compete with the local banks, and you would be, if you're going to take individual deposits, this is going to open up another can of worms, because now you're going to get the local banks opposing you. But you could fix that in several ways. One possibility would be I was thinking you could put a fee on these deposit accounts. I mean, my bank charges $15 a month if you don't have up to a certain amount, as a deposit fee. So charge a fee that only the marijuana businesses are willing to pay, and therefore you're not really competing, because this is a business that the other banks are afraid to take because they're afraid of the feds. So that's one possibility. Another possibility, I forgot what the other possibility was. Well, I'll get to that. Another problem is that the feds are, likely to shut you down, and now you've got your taxpayer money at risk if you're going to have a public bank that's holding taxpayer money and cannabis money. So that's a serious concern. But there are bills on in Congress to change the law. I suspect they're going to change the law fairly soon. And I saw a proposal in California. I mean, it's a bill that was filed recently in California to have a publicly owned bank that would take cannabis money, and it would take, it would just be a depository bank. You wouldn't make loans, and it would be limited to cannabis, and then you would have a series of these banks. So the third problem is that the Federal Reserve has refused to give a master account, Fed master account. And you might probably know the Fourth Corner Credit Union sued, and they finally got a decision from the 10th Circuit that the Fed was supposed to, the Fed had to set up this master account. And they said, okay, we're going to set it up, but you can't use it as long as you're taking in illegal money. So they're making some progress in this legal area, but there's still that problem that you're up against the Federal Reserve and the federal law. But I suspect that will change. But anyway, so this proposal in California was that you would have a series of banks all across the state that would, I mean, you don't have to have physical banks. They can be internet banks that would take in cannabis money and basically trade with each other. Or there are various cryptocurrency systems that would also take in that cannabis money. So anyway, that's an interesting possibility. It's got pluses and minuses. I don't recommend it or not recommend it, but I know it's an issue, so worth discussing. And then a final thing, an objection that you hear from people is like, you want to give our politicians a bank? We already have corrupt politicians, and you're going to give them yet more access to manipulating our money. But the thing is, you're not giving it to politicians. I mean, if you follow the Bank of North Dakota model, you're getting independent bankers to run the bank. We already have loan funds that are making loans. This is public money that's being lent into the economy very successfully, very prudently, and you don't find politicians manipulating who the loans go to. So our government already knows how to do that, how to make sensible, legal, honest, profitable loans using strict underwriting standards. And you wouldn't have any incentive to speculate because you're not going to pay bonuses, fees, or commissions. The people that work there are just going to be civil servants doing their job, just as they are in North Dakota, where the highest paid person, the last time I looked, was, I think it's $270,000 was the president. So, I mean, it's compared to 20-some million for Wells Fargo. So, anyway, nobody's making a lot of money off this deal. They're just doing their jobs, performing a service. So that's all I have to say on the subject. These are my two books, Public Bank Solution and Web of Debt. And you can go to publicbankinginstitute.org for more information, and my own website is ellenbrown.com. Thank you very much.
Questions?
Sure.
Okay. All right, we'll have a period of questions, not too long because we have other speakers. But go ahead.
Yeah, you can call in.
Dr. Brown, I heard a rumor that you have a new book coming out.
You heard that from me about 10 minutes ago.
I heard about it before I tested you about it.
Okay. Yeah, I do. It's called The Coming Revolution in Banking, Democratizing Money in the Digital Age.
And how does that relate to the cryptocurrencies that you mentioned earlier?
Well, it's another thing like cannabis money. There's pluses and minuses to it. But the way I've written it, I mean, it's complicated. I don't think I can do it in a couple of minutes. But right now, we have lost the power to create money. Our government has lost the power to create money, as we know. So it's money is created by Wall Street, basically, and they control the government because they control the money. So how do we get that power back? Well, you could have a Fed coin, you know, the Federal Reserve. First of all, we want to get the Federal Reserve back, but let's assume that we actually had a central bank that was actually publicly owned and publicly controlled and was our bank. It could issue a cryptocurrency that would be very similar to the greenbacks or the money that, you know, I mean, it would be dollars, but it would be digital dollars. Right now, they only issue 5% of the money supply. So if you had a central bank that opened up its deposit window to everybody, in other words, we could all bank there, and the whole system, basically, if you had a national public banking system that would run smoothly and securely because of this whole cryptocurrency concept, then, you know, we the people could recapture the power to create money. But you probably have to read it to understand what I'm talking about.
Any hint when it will be out?
Maybe in the fall. It's I've got they edited it to death, and so it'll take a little while. But I'm glad to have good editors because you know, it's kind of. I was challenged to write this by the Democracy Collaborative, and so it's a little out of my. They said they wanted me to set up a national public banking system. How would you set up a national public banking system? So I really had to think about it. You know, think about all these ins and outs.
I don't know if this is the place to ask this, but I was wondering if the state public bank, how it would benefit our state pension fund, public employees retirement account, which right now seems to be having some difficulties. But
Well, I have always.
Repeat the question.
Oh, the question was, how would it benefit our state pension funds? I haven't followed your pension funds, but I know in California, you know, they've made some really bad investments. In fact, we had a pension, San Francisco City Pension Fund, somebody from their board approached us and said, we want to form a bank. He said, we'll put up half if the city will put up half. He said, he was just disgusted. He'd come, we just went to dinner with him. He'd come out of a meeting where he said, we just squandered $60 million on, you know, something. I don't know. I mean, they can invest in anything. In other words, they're not making necessarily responsible investments. They're definitely not looking at, you know, ethical is not necessarily one of their standards. So we would argue that they can put, well, you know, and I mean, in terms of what they invest in, they're investing in what they think will make up, or what their investment advisors, who are Wall Street people, tell them is a good investment, which is or is not. You know, they've lost a lot of money. So anyway, we think they could invest in a state-owned bank and make more money, and they would help the state at the same time. So it's another thing. I like that model of it. It's a closed loop. You know, you keep your money in the state for your purposes, with your guidelines for, you know, what's ethical, what's going to help the people, etc.
Are you familiar with Bernard Later?
Yeah.
And the Tower TRC. The question is, how does alternative currency mesh into this conversion to public banking?
Well, I think that what a national public bank should be is basically a national community currency. In other words, we the people create the money. That's the way banking works now. You actually create this, it's your credit. You have created this loan, or you have promised to pay this back. And the bank is just there turning your IOU, which your grocer is not going to take. Your bank turns it into the bank's IOU, which they'll do for a fee, you know. So that's what a community currency system is, basically. You know, you're trading IOUs. It's debits and credits. You do something for someone else, and then you get a certain number of credits in the system that you can spend on someone else. So it seems to me that that's really what we want, is where we are monetizing our own credit, turning our own credit into money. And if it's a public system, then you've got a public, it's another closed loop thing where the profits are going back here. They're not going offshore or into this speculative economy that we have no control over, and that's sucking the resources out of the productive economy.
Corey?
Yeah. Okay. do the advisors to these pension funds or whoever is making the investment decisions understand that were this to be done through a public bank, there's almost an automatic safety aspect to the investment. If they squander the investment, but it's in their locale, that money still circulates. And so it would seem that they have some level of safety there.
I've made that argument on China. Everybody worries about the Chinese non-performing loans. They're not worried about their non-performing loans because this is just extra money that's gotten into the economy. I mean, a loan that defaults is just money, newly created money that's not paid back. If it's created by a bank, it's not owed to anyone. I mean, it's not like it came out of somebody's purse. So if you have a few defaults, you just factor that in and you think, well, we need some extra money to create demand in the economy. And their only problem, of course, is they're part of the WTO, and you know we're breathing down their necks and saying you got to balance your books. But when they were really communists, they didn't worry about balancing their books. They knew that money was just something that it was just sort of an accounting function. They issued it for what they needed, and some of it paid back, and some of it didn't. It didn't. Yeah.
Okay. We'll take 2 more questions, and then we'll move on to the next speaker. Yes.
I wonder if you're familiar with the article that was in Yes Magazine recently about the loans that North Dakota made to.
Oh yeah, that's probably Matt's article.
Yeah, and I just wonder what you have to say about that.
Well, yeah, well, they weren't loaning to oil. This was a bit controversial that the Bank of North Dakota, I guess the police department needed loans in order to help enforce the concern of the North Dakota people was that they were getting run over by these water protectors. Yes, thank you. Okay, water protectors. Anyway, but it's their mandate to make loans to local governments. So I mean, if you can't say to an agency, I'm sorry, we don't approve of what you're doing. The agency, that's a political decision what the agency does. What the bank does is make loans for their municipal governments and for their agencies. So.
Our last question for this part of the program, I want to mention that the questioner is Cliff Wilming, who is running for county commissioner in Boulder County. And are you endorsing public banking?
Thanks, Errol. So I guess, yeah, it's relevant to that campaign where I come from Boulder County. And what my question basically had to do around like economy of scale with public banking. In other words, how do you see that affecting public banking at the level of a federal government, a state government, or even a municipality or county? Is that something that would play a heavy kind of determinant in how that would play out at a local level?
Mm-hmm. Well, we do need some models. So what we're hoping, like the governor of New Jersey ran on Walt will tell you about that, ran on a state bank platform, and he was just inaugurated in January, and he's already got a bill on for a state-owned bank. So he's got the political will. That's really what you need, is somebody with a political will. And so if he gets a bank set up and running, and it does well, then it seems to me everybody else is going to follow. But for a small city to try it has proved to be difficult. Like Santa Fe has tried it, but they just really have limited resources, and it's just a challenge. So it would be best if a state did it first, or it just seems to me that once you've got a model, then other politicians are willing to follow. Okay, thank you.